Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. Okay, so today's one chart is Dow Theory. Today we're going to talk about what Dow Theory is, what it tells you about the overall market conditions, and then what it's telling us about the markets right now. So first off, what is Dow Theory? Dow Theory is named after Charles Dow, who's the editor of Barron's over 100 years ago, early 1900s, and essentially considered the father of technical analysis. A lot of his writings really set the foundation for what we do as technical analysts, as chart analysts, because he talk about things like, the idea of stock indexes, grouping stocks into buckets and then charting them or analyzing them over time as a way of understanding what the overall market was doing. Before that, you literally just looked at individual stocks and made conclusions about the broader economic conditions. What Dow Theory, what Charles Dow came up with was basically the idea of looking at indexes of stocks to determine the overall strength of the markets, what the market was, quote unquote. Also, the idea of looking at different parts of the economy. So he looked at basically two different segments, the producers of goods and the distributors of goods. And the chart we're looking at here is the Dow Industrials on the top, or the producers of goods, and the Dow Transports on the bottom, or the distributors of goods. Now, when he created these, it was the Dow Industrials and the Dow, the railroads. And the industrials were the big industrial companies producing goods, creating stuff. And then the transports, the railroads, were the way that you got those goods out to consumers. And so by looking at those two and making sure that they were in agreement, that told you overall conditions were positive. If the industrials were doing well, but the transports were not, that told you that the distribution, is really not, there's not an increase in demand for goods, or else there would be more stuff being moved around. If the industrials weren't doing well, same thing. It meant, orders were not really coming to the level that was expected. And so when they were both doing well, when they agreed, everything was fine. When one of them disagreed, when you had a disagreement or a non-confirmation between the two, when one did one thing and the other did something else, that told you to be concerned a little bit. The indexes have evolved, and now the Dow Industrials really aren't just traditional blue chip industrial stocks. It's big consumer companies and financials and things like that. The transports include things other than railroads. It includes shipping companies, but also includes things like airlines. It could be part of the transport index. So, it is not a clear producers versus distributors as Charles Dow created it. However, they do represent some significant, mega cap stocks that are widely followed, widely owned. And so the idea of looking at different parts of the economy and whether or not they're both doing well still, I think, has a lot of value. Getting to the second point, what they tell you about the overall conditions, I think looking back at January to February of 2020, you can see why this is still, in my opinion, a valid set of charts to look at. You can see that in January, February of 2020, the Dow Industrials made a new high, a new closing high. And you can see that the Dow Transports actually made a lower high or lower close. And so as the industrials were going higher, that was not confirmed by the transports, which actually made a lower peak at that time. So that's sort of a divergence. That tells you that conditions may be challenged. The real signal, though, is after a divergence when they both break down. When you see the indexes confirm each other by breaking to a new low, that's the real signal. So in mid to late February, the divergence sort of puts it on your radar that things may be a problem. The breakdown to a new swing low is what convinces me, or should convince you, that the conditions are starting to deteriorate very quickly. So what's interesting is here in September and October, the Dow Industrials looks a lot like the chart of the S&P 500. You bottomed out on March 23rd. You accelerated into the June peak, and then another peak here in early September. And from there, the next 2 months essentially were a pullback phase of lower highs and lower lows. What's interesting, though, is you had sort of the reverse of the divergence from January and February. You had the industrials actually making a lower peak, and the Dow Transport's making a higher peak. But again, that's still a divergence where both of them are not confirming one another. When they both broke down through their most recent swing low, which happened the last week in October, I certainly got pretty negative about where the markets could go, seeing both of these breaking down, seeing a bearish divergence and a breakdown. It looked a lot like the pattern we saw back here in late February. However, That was negated. That was invalidated. It was a failed breakdown. You can see the Dow Industrials very quickly turned around the first week in November, pushed it to a new swing high. Same with the Dow Transports, which soon after made a new swing high as well. And once they both got above their October and September highs, that gave the all clear sign that it was not a deteriorating environment. It was more strengthening. And that's where we're at today. So why is it a one chart for today? Well, here's the thing. We have not gotten a divergence yet, but when we start looking at a top and you see the euphoric sentiment conditions, what I think we've seen, you've seen the breadth conditions, which were so positive. So it makes you think, at what point are we going to see some sort of reversal and some sort of a deceleration of the breadth conditions? Then one of the things I would expect is a Dow Theory non-confirmation, where one of these makes new highs, the other one does not. You can see in December, they were here. You can see in January of 2021, they've both confirmed a new high. We've had a confirmation of both of them going to new highs. One thing I would be looking for on this chart is, do we get a lower peak on one or both of them? Do they, a confirmation would be that neither of them goes to a new high. If one of them fails to get above its January high, that would be a non-confirmation and suggest a bearish divergence, suggest a higher probability of a market downtrend. The other thing I'll be looking for is I put these purple horizontal lines, which really identify the swing low from December. You can see that the Dow Industrials bottomed out sort of that second, third week in December. You can see that the Dow Transports were right at the end of last year before the reversal and the move to new highs in January. So I've put a pink line, a purple line identifying those swing lows. If they're able to hold that swing low from December, I think that would be compelling. What's interesting for me is that the Dow Transports actually broke down through the December low this last week. It was actually on Friday's close, I want to say that was, before the bump higher the first couple trading days here in February. So seeing if that breakdown is confirmed by a further move to the downside, the Dow Transports getting to around 12,000 would confirm that. If the Dow Industrials would get below around 29,700, which would take up below the December lows, if that happens, I also think that would indicate a deterioration, again, from two different parts of the economy. And if you see that, I think either one of those, a bearish divergence at the very least, at the even more so, be a breakdown of support that would suggest increased likelihood of the market correcting more, either in price or time or both. So Dow Theory, named after Charles Dow, really came from the foundation of charting. A lot of the stuff that we talk about, I say things like a stock needs to make higher highs and higher lows. That literally comes from Charles Dow's writing, 100 plus years ago, when he was talking about how to analyze price action, the idea of charting the data over time. So the idea of looking at different parts of the economy and using that as a way to evaluate overall economic conditions in the form of the stock market still very much holds true. The idea here is looking for non-confirmation or a confirmation where one of them does not make a new high when the other does. And the final thing would be a breakdown when they fail to hold a previous support level and transition from making higher highs and higher lows to lower highs and lower lows. That's what I would be looking for right now on the chart of the Dow Industrials and the Dow Transports, or what we call Dow Theory. That's it for me, Dave Keller, and the rest of the team here at Market Misbehavior. Hope you all stay safe. Talk to you soon, and thanks again.